Hello traders, welcome to another session of Price Action Insights. My name is Chris, and I wanted to just make one final point on liquidity aggregators. So you've got the aggregator and you've got the contributing banks, and there are many means by which traders and institutions will access liquidity, whether it's via the aggregator or the independent bank. And there are a wide range of algorithms and needs that need to be met based on the assessment and the anatomy of the state of liquidity within the aggregator or within the marketplace at any given time. And the state of liquidity is in constant change. So depending upon what price we're at any given time, and whether there's a liquidity pool within proximity or present, or whether we are in moving through a thinner zone of liquidity. Other considerations like what data points might be pending or coming up later in the session, and the time of the session, of course. So, but what we have done in order to control the prices that we get when we put our liquidity or put our orders into the market um, is we have a custom graphic user interface that taps into liquidity, and they're usually tap in liquidity using Fix API. And say, for example, we are looking to put a 10 million block into the market. Well, at different times of day, as the liquidity changes, and depending on the currency pair, we will need to have a setting as to what blocks of liquidity size we want to deliver into the market. So we'll typically have a 2 pip tolerance, maybe 1.5, 2 pip tolerance. The liquidity will get pumped in the market depending on the currency, but typically on a euro it'll be anywhere between 10 and 5 in a shot. So if we put the liquidity into the market, what we're effectively doing is, rather than us putting our liquidity into the marketplace and letting the marketplace determine whom and where we are going to get filled, rather we put our liquidity into the marketplace and we will draw liquidity toward our orders. So there's a big difference in over time and over sample size in terms of how many pips you can preserve and will not get taken up by the marketplace. In this session, I want to just talk a little bit about the price when it's in a low liquidity state. When price is in a low liquidity state, it is a seemingly harmless state at which price is really just in a consolidation phase. So, for example, in this case, after this move lower, price paused briefly here, and then the move ended here, and then we went into this point of stability. We call it relative volume stability. So obviously what the market is telling you here is really price is just moving. This is a 5-minute chart, and price is just simply moving in about a 5 or so pip range. Now, the longer it endures this range and price just trades within this natural range, effectively what price has done is a price move was triggered by, perhaps in this particular case, an event, or the fact that we were in a low liquidity state and price pushed against the weak side. Price started to run, the algo shifted, and the run continued as the market sought liquidity to establish a base. Now, there's typically a reason why and where price stops and establishes a base, but for the sake of this discussion, we just want to talk about how when the market spends an extended period of time in what we refer to as a drying or slowing or state of dropping liquidity, effectively what's happening is that not only is the tick frequency slowing down, we're also seeing slowing movement. But when you study the flows, you will find that within proximity of the area where price has found its balance, we're actually seeing the depths of liquidity become thinner and drying up. So you actually have a longer ladder of liquidity. So for example, when volume is very high, you might have depths of, let's say, uh, depths of 100 or 200 or 300 million that are in reasonable proximity of current price. But as the longer we spend in this state of balance, you'll find to, to you will find that depths of liquidity to 300 million will run the span of uh, of of 10 or 20 or 30 pips, whereas in a thicker area of liquidity, it might be within 5 or 10 pips proximity. So the state of liquidity has changed. And what happens is that as liquidity drops off and the tick frequency becomes much slower and the range of the movement becomes very tight, as you can see here, we're in the lowest state of liquidity within this duration. And when we're in the lowest state of liquidity, that is when you see that there is a push to the weak side. And quite often, the weak side is going to simply see, because you have the presence of liquidity in this area right in here, and you'll see the weak side will push, and then the algorithms will shift, and you'll see price drawing back up towards the next point of existing liquidity. And you'll often see this surge, a surge that occurs like this, for example, or it can be a significant surge. You can see here how at the time of day, of course, is still in the early hours in the Asian session, how liquidity dried up to close to nothing, and then all we needed was a very, very small push of volume looking for a price, and that will change the engines. And you can see how price moved from 18 to 27, so a quick 10 pip move, and you can see that this move lower is not sellers, it's just simply filling the void of bids, and the last level of support is down here, the liquidity is down here, so price is just bleeding back to the last state of liquidity because some would have been left behind. You can see how it happened here, very low liquidity state right in here, then we get the shot and price drifts back to this stable point of liquidity. As you can see on this simple chart taken from yesterday, we have virtually countless price movements throughout the day that are as such. So you can see prior to any move that breaks out, you can see the market is it is typically reaches its lowest liquidity state within a consolidation before you start to get the price move where the market is seeking liquidity. Now, in this particular example, we're only looking at the 5-minute chart, so a lot of information is buried within these candles, but you can see it. After price releases and extends, goes into a lower liquidity state before the next move, and the market is constantly changing dealing frames. So you have a core dealing frame, I measure the bodies, core dealing frame, low liquidity state, price release. Core dealing frame, low liquidity state, price release. Volatility, low liquidity state, core dealing frame, price release. Price balances, so it's seeking liquidity, price balances, low liquidity state, price release. You can see it here, 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 here. And what's important to understand is that as we break out from, for example, see how price moved, went into a low liquidity state. As we break out, the market is moving into a new environment, a new state of liquidity. So as price starts to move, it's going to move. Price moves higher and thinner, and typically towards the end of the move is when you will see the thinnest depth of liquidity from a best bid, best offer perspective. And you'll experience more institutions taking last look. So, and typically when price rises to this magnitude, usually the area at which it is beginning to slow is an area where there's a liquidity pocket. So not only do you have rising and thinning price, you actually will have a liquidity pocket that will absorb. It will absorb just the remaining liquidity, and you often see a fairly rapid drop into the last point of liquidity. And where it gets very interesting is the price relationships within the movements as price breaks out from a low liquidity state. The same applies to long-term charts. This is a daily chart. It applies to tick charts, 1-minute charts, 5-minute charts, 23-minute charts, 46-minute charts, and everything in between. So this is the scalability of price behavior in fractal. So if we look at, for example, this is a daily chart on the pound dollar, you'll notice that each time we see any significant move out, we are in a low liquidity state. You can see here, you can see it here, the breakout move here, low liquidity state, breakout, then price draws back, rebalances to liquidity. Obviously you can't see all the details in this chart, but rebalances back, low liquidity state, breakout, low liquidity state, breakout, low liquidity state. This is more of a bleed. This is a bleed back, drifting back up this leg, and then we had a event, comes right back, low liquidity state, breakout, low liquidity state, price move, sitting on the lows. I use the bodies a lot. Low liquidity state, breakout, low liquidity state, breakout. Price changes its dealing range. The bodies move lower, low liquidity state, continued movement. Low liquidity state, breakout. Low liquidity state, breakout. So these obviously are much more profound on the smaller time frames. You can see what's going on a lot more clearly, of course, but you get the point. Low liquidity state, breakout. So each time price moves out of the low liquidity state, it is moving into a new environment of liquidity, and then the processing of orders and delivery of orders changes slightly, although it's constantly changing throughout the day. On a micro level, it is also making adjustments on a macro level once price starts to move. Low liquidity state, price move. Low liquidity state, breakout move. Low liquidity state, continuation. Low liquidity state, breakout. It's important to be mindful of the presence of liquidity at future price. So while price may be at, say, for example, in this example, at 1373, it's important to have a sense for where the presence of liquidity becomes thicker or more material at potential future price locations. And I'm not going to get into all that here. There's a manner in which, and a process by which, that we train people in Pro Traders Club to get a real sense for anticipated areas of liquidity by going through a process of exercises so that you can internalize the price behaviors and really start to establish a connection with the market by interacting with price with a set of parameters. It ultimately blends your unique psychological profile to specific aspects of price character and price behavior, and that's one of the things that we aim to achieve in the process of developing traders in Pro Traders Club. So I'm just going to leave it at that for today. Good luck with your trading.